So $10 billion of what this market calls tokenized private credit is just one company's internal loan book sitting on a private computer. Doesn't trade, cannot be pledged, just a database. And that single fact means that the market that the institutions are underwriting is roughly 40% smaller than we thought. So Larry Fink said tokenization is roughly where the internet was in '96. And he's right about the direction. But what he's not taking into account is $26 billion headline. He's talking about what comes after the market corrects its measurement, reprices economics, and stops confusing a filing cabinet for a financial instrument. So welcome back to the Control Loop. I am Dariia. Today we have Parth and our distinguished guest Mansi, and we're not doing a tokenization overview. We're doing a market correction. So roughly 6 weeks from now, on June, New York's UCC Article 12 will take legal effect. That will resolve the collateral status of tokenized assets under the governing law for most institutional financing in the world. HSBC has launched its US tokenized deposit 2 weeks ago. DTCC tokenized collateral goes live also this year. 8 catalysts in the past 12 months. The space is moving very quickly, but most institutional players still cannot answer like 3 basic questions. Which layer captures the economics? Which wrapper determines the distribution? And what liability they are currently inheriting by choosing wrong rails. Mansi has recently published a report, which we'll link in the description, that answers all of these 3 questions. She is a digital assets and financial services lawyer formerly at Gemini with direct operating experience across tokenized products, derivatives, OTC, cross-border licensing, and regulated market infrastructure. So Mansi, the market has been celebrating this $26 billion tokenized real-world assets, and Jenny Johnson, the CEO of Franklin Templeton, one of the most credible operators in the space, has called that Bitcoin is also the greatest distraction from the biggest opportunity in finance, which would be tokenized assets. So she's building Benji across 7 different blockchains. The smart monies and the institutions are growing as the headlines are big, but your report says that the number is misleading and is also consequentially wrong. Could you dive deeper into that?
Yeah. So Jenny Johnson is right that tokenized assets are the opportunity. She is, however, not right that the 26 billion headline measures it accurately. The number that actually travels conflates 2 categorically different things. One is represented value, any asset sitting on a ledger. And then there's distributed value, which is the value that actually trades, settles, or gets pledged as collateral between independent counterparties. They are not the same product. I'll start with private credit, for example. The category that gets the most coverage, the headline says $18 billion. 13 billion of that is one originator, Figure HELOC, which is recording its home equity loan book on a private blockchain as an internal system of record. It does not actually circulate. It cannot be pledged on chain. No independent counterparty holds it. And strip that out, and life float in private credit is down to $5 to $6 billion. The received wisdom says that private credit is the flagship tokenization vertical, but the corrected data shows something else, which is that it is very, very overstated at this point. The 2 categories where headline and distributed value actually converge are US Treasuries and tokenized money market funds. That convergence is not a coincidence. It is the clearest possible signal about where the real institutional adoption exists. Everything else is a database decision being mistaken for a market structure decision. $14 billion of tokenized private credit is one loan book on a private computer. That is not a market. It is a filing cabinet.
Yeah, Mansi, I think this is going somewhere in the range where, Franklin Templeton, Sandy Call, I heard her saying that utility is a much bigger market. And I think what you are stressing here is that you have, that is the difference between the headline number of actual tokenized value and the distributed value. So I think what you're referring here is that the distributed value is much higher, and that is where collateral and those facilities will play a big role. So I want to push on that, Mansi, because Carlos Domenico, of the CEO of Securitize, the firm that is processing 70% of the US institutional tokenization, and has made a very clear distinction. He said tokenization per se is just putting your security on a different ledger, the marginal efficiency gains. But He said that if you bring DeFi composability into the RWA space, it could make it explode. And is the wrapper irrelevant, or the Securitize CEO actually makes the case that the wrapper plus composability is where the value is accruing? And is he right, or is he kind of self-serving?
That is a good question to ask. Domingo is actually right about the diagnosis and yet conflicted about the conclusion. The incentive to undersell wrapper economics is completely transparent. Securitize's own value accrues to the infrastructure layer underneath the wrapper and not to the wrapper itself. So when he says that the wrapper alone is marginal, he is correct. What he's not saying loudly enough is that his business captures the layer that does not compress. In under 2 years, the ERC20 wrapper is openly replicable. Once 3 or 4 credible wrappers exist in the category, pricing hits the floor fast. We have already watched it happen in real time. Now, look at what Securitize is actually worth. It's a $1.25 billion pre-money on their SPAC transaction. 55 million in 9-month revenue. The public markets have already priced the infrastructure moat. No issuer or wrapper business commands a comparable multiple on the tokenization revenue, not a single one. The institutions building the wrapper, for example, BlackRock, Apollo, KKR, Franklin Templeton, are not wrong about tokenization. They are building into the compressing layer while Securitize builds the toll road underneath them. Now, that is Domingo's actual insight. He just has the courtesy not to say it that bluntly. So, transfer agents, custodians, and FMI operators are the toll roads. Wrappers are the cars. BlackRock is building a very prestigious car.
So it still sounds like, this institutional PMF on chain on tokenization is still more talk than actually action. And I know action's probably gonna follow. We've already seen a lot more than even last year. But what is, I guess, the genuine institutional PMF live already? Not just all the talk of the conferences and podcasts and panels that everybody's been going around doing, BlackRock, JPMorgan, Franklin Templeton. What is the real adoption with real volume numbers and counterparty use, which is not just one database? Can you just list the verticals and tell us why those are and why outside of them is just a story?
Yeah, so there's actually, per my research, there is 4 verticals. I will be precise about why each one qualifies. The first is obviously tokenized money market funds as institutional collateral. So Biddle, Benji, OUSG, Wisdom Cheese, UTGX pledged today in live production at Deribit and Binance as eligible non-cash collateral. This is not a forecast. This is a current practice. The demand driver is not yield. It is actually collateral mobility. The ability to post margin on a Saturday night when derivatives position moves against you without waiting for Monday's redemption window, without a phone call, without manual reconciliation. The operational capability has no equivalent in traditional money market fund structures. And this is what makes the category structurally durable, regardless of fee compression. The second one is tokenized wholesale payments and repo. So JPMorgan's Kinexys processes $2 to $5 billion daily and has cleared over 3 trillion cumulatively. HSBC Orion, Citi Token Services, BIS's Project Agora. This is institutional product market fit at production scale. Most tokenization commentary ignores it entirely because it just does not appear on rwa.xyz. The third one is tokenized US treasuries as the on-chain yield primitive. So $9 billion converging with distributed value, serving simultaneously as the base yield instrument for on-chain treasuries, stablecoin reserves, and DeFi collateral at the same time. And the last one, and this is the non-consensus position really, which is maybe the showstopper of my report as well, is Regulation S offshore public equities. So 82% of tokenized US equity value sits on 2 platforms, both operating under Regulation S for non-US retail distribution, and the winner of this category will not be a US firm. everything outside these four: fractional real estate, fine art, commodities beyond gold, retail, PE feeders, has failed to reach an institutional scale despite years of significant marketing, as Dariia correctly mentioned. So, tokenized real estate, I would say, has been the next big category for 3 years now. Live float currently is $200 million. That is not early, that is failed.
Got it, Mansi. I think this is especially the regulation as offshore public that mostly what you're projecting is that a lot of the transactions and 82% what you're saying is sitting outside US jurisdiction. I think this is something which will become very critical for the coming days in terms of the regulatory considerations in the US, and I think a lot of these things have to move to US. And these numbers are very clear, Mansi. I think $9 billion is just very small number, and it should be much higher. And JPMorgan is actually doing a much more bigger role here with the wholesale payments and the repo, and that market is nowhere discussed when we talk about RWA. And you are right that RWA XYZ is not covering these things, which are much bigger story than any of those. I'll go harder on the money leg, Mansi here, because BIS, the most credible institutions in the global monetary infrastructure, has Huan Song Shin on record, who has said that tokenization combines the record keeping function of a traditional database with the rules and logic that govern transfers. And he is prototyping Project Agora with 7 central banks and 40 plus regulated financial institutions, testing since January 2026. So if BIS is building the unified ledger architecture for a 195 trillion in annual wholesale flow, and A16Z just argued that the stablecoin have evolved into foundational plumbing for a new global financial stack, why is the institutional conversation still dominated by tokenized asset categories that are a very fraction of that scale?
Yeah, that is a very astute observation. And the answer is because the asset side is visible and the money side is invisible to the standard data sources. So, rwa.xyz, the site that everyone uses for market sizing in tokenization, does not actually capture kinexes. It does not capture HSBC or IN. It does not capture city token services. These platforms do not have publicly queryable on chain addresses the way a tokenized fund does. So they disappear from the headline figures entirely. The measurement methodology creates the illusion that assets are bigger than the market. Now look at the actual scale. JP Morgan alone processes more tokenized dollar volume in a single day than the entire distributed RWA asset market has circulated in its history. $3 trillion cleared cumulatively. And Shin's Project Agora is prototyping the infrastructure that would connect all of these wholesale platforms, CBDC plus tokenized deposits on a unified ledger. The lessons learned report lands in H1 2026. That's not a research exercise, that is an architecture of what comes next in terms of financial stack. A16Z, again, in their stablecoin piece, have made the same structural point about the application layer. They've said stablecoins have evolved from a niche trading instrument to foundational plumbing. Payment-specific chains built for predictable transaction costs. Institutional networks like Canton designed for regulated entities. Bank connectivity layers translating between on-chain infrastructure and legacy core banking systems. The financial system is being rebuilt at the money layer. The asset side gets the conference panels, and the money side actually gets the institutional flows. Those are not the same thing. So, in summary, JP Morgan actually clears more tokenized dollars before lunch than the entire RWA asset market has cleared in its entire history. That is the market no one is talking about.
I mean, this RWA is so much smaller than like what JP Morgan makes before lunch is like a very provocative statement, and like your report is full of that. It's really digging into all of the myths and talk and versus the realities of like what's RWA, what's tokenized, what are the actual values, what's sitting in somebody's database, and what's genuinely being on chain and what's genuinely being traded. But like one of the, I guess, most provocative statements that I have seen in that report is that you say that blockchain selection is actually secondary to all of it. So to quote, it's like in a market where everyone has an opinion about which chain should win. There's like Ethereum Maxis versus Solana's versus Aptos versus Canton, and each of them has their own pros and cons and big crowds of fans. You are actually saying that it's been optimized for the wrong variable entirely. Could you clarify for listeners who haven't seen it yet what's the case there and what then they should be focused instead, if not the chain choice?
You left out EternaX, which we'll come to later. The chain debate is actually a proxy war being fought by people who have not yet had to actually distribute a tokenized product at institutional scale. The chain choice actually determines your technical performance. The wrapper choice is actually what determines whether your product exists legally. A poor wrapper does not compress your economics, it kills your product before it launches. Here is a proof. For example, Regulation S versus Regulation D under the US securities law. Two legal wrappers, same underlying asset, tokenized US equities. Regulation S allows offshore distribution to non-US retail, global reach, lower friction, genuinely large addressable market. Regulation D restricts you to US accredited investors only, no general solicitation for retail users. Global markets and X stocks are examples of this analogy that I'm drawing. Both Regulation S together control only 82% of $1 billion plus tokenized equity market. Denari, the largest US regulated platform operating under Regulation D, sits at $3 million in live float. Same asset, same technology, different wrapper, 3 orders of magnitude difference in market outcome. Tell me again that chain selection is the primary variable. In terms of jurisdiction, Luxembourg's RAIF, Ireland's ICAV, Hong Kong's OFC, and ADGM, these determines your AIFMD passporting rights in Europe, your eligible investor base, your cross-border distribution architecture, operators structuring tokenized funds for European distribution without Luxembourg, RAIF, or Irish ICAV are accepting commercial drag for reasons that do not survive scrutiny. They are not compliance footnotes, they are the entire product. So in summation, I would say Reg S versus Reg D, same asset, same technology, one platform has $800 million, one has $3 million. The difference is 4 words in a legal document.
Now, this makes a lot of sense. This again points to the same discussion that we had that, US regulatory will push towards more of Reg D and would try to, ease it out. I understand right now it is 82%, which is comparably high, but from my understanding, there should be much more regulatory developments in the US which will push more percentages to US onshore. So let's talk about the white space, Mansi, directly. Securitize has 70% of US institutional tokenization running through one transfer agent, which is BlackRock, Apollo, KKR, Hamilton Lane, VanEck, and now NYSE digital trading platform. That position took years and deep regulator facing relationship building to construct. And you say the equivalent position does not exist in Luxembourg, Ireland, Hong Kong, or ADGM. Why hasn't anyone built it, Mansi? And is this window actually still open or is it already closing?
So, 2 reasons it's not been built yet. The first one, the US market validated the thesis and concentrated early capital on solving the US problem. Securitize moved early, built regulator-facing relationships with the SEC, created network effects that compound. Every major US issuer went through Securitize because Securitize was already there when they arrived. First mover advantage in a regulator-facing layer with high switching costs is not temporary, it is structural. Second, the non-US jurisdictions are each genuinely different. Luxembourg RAIF requires the CSSF regulatory relationship. Ireland requires the Central Bank of Ireland authorization and a specific US island tax structure competence. Hong Kong OFC requires SFC recognition frameworks. ADGM requires FSRA licensing across FSP categories. You cannot copy paste the Securitize playbook from New York to say Luxembourg. You rebuild the regulator facing relationships from scratch in each market. But, and this is critical, that the difficulty is the opportunity. Traditional fund administrators in those markets, for example, Northern Trust, State Street, BNY in Ireland, are extending gradually into tokenization, but none of them combine transfer agency, qualified custody, issuance infrastructure, and ATS operation under one regulated umbrella. That vertically integrated position does not exist in any of these four jurisdictions. And the non US tokenization market will produce three or four regional winners. The race has been not started in earnest. Building or acquiring that position in 2026 is materially cheaper than competing for it in 2028 when everyone has figured out what they missed. So Securitize took the US transfer agent position before anyone else understood why it mattered. In Luxembourg, Ireland, Hong Kong, and ADGM, that position is still available, and that window is closing and closing fast.
I understand also from your, let's say, job and your standing in the space that you would obviously put a lot importance on like the legal wrappers and the rights and all of those defining things. But I would like to maybe push back on like the thing that we have previously discussed, that the chain choice is secondary. Because so far, since like, Ethereum launched and Solana launched and all of this years of stuff, the world has been a different place since I am very convinced it is today and what it is going to be in the next couple of years. So all of these assets that are being tokenized, that are being built, the relationship with regulators, all this like whatever Genius and Clarity Acts that are coming out, they are talking about assets that have their lifetime longer than most tokens like even exists, and most like startups that try to launch them are in the space. So these assets, they derive their value from outside, but they are taking the risks of the chain for the distribution. And I think that's actually technically very, very important. So the part of your report that we have not discussed just yet is that there is security in terms of safety level cryptographic risk to what is the chain choice of the rails of distribution of these assets. So for example, a few weeks ago, Google Quantum AI has published their report that disclosed that, breaking elliptic curve cryptography that secures all of the chains that we've discussed so far, that Solana, Ethereum, Canton, you name it, actually requires less than like 500k physical qubits, which is like 20x reduction from like the estimates we had even 2 years ago. And it can be executed within block time, like in minutes. Your keys that are authorizing all of the issuance, burn, mint, are gone and are compromised. Coinbase has also set up their own independent advisory board. It is chaired by Scott Aronson, and Dan Bonnet, very most prominent voices in cryptography and quantum computing. They have also published their own paper that concludes that, the window to prepare for cryptographic migration is narrowing. So it's not just a technology risk. It is in your report, and it's correctly named as an institutional liability that compounds every successful month. So every new dollar that comes on chain that is not safe to quantum is actually liability and debt. Can you also go into detail like there? What is your view as a lawyer on this?
Yeah, so a tokenized asset inherits the cryptographic assumptions of the blockchain that it runs on. When you choose a rail for a long duration institutional product, you're not making a technology preference, you are making a liability decision. The Coinbase advisory board identified 6.9 million Bitcoin with exposed public keys as priority targets. They rated Algorand and Aptos as the most quantum ready layer 1 chains. Ethereum and Solana face more complex transitions. Post quantum signatures are 10 to 100 times larger than the current ones. One estimate puts block size expansion at 38 times. These are not abstract theoretical concerns, these are engineering constraints with legal, operational, and reputational consequences when they land on products holding institutional collateral. So, for tokenized financial products, the exposure is not at the retail wallet layer, it sits at the control plane, issuer admin keys, transfer agent permissions, upgrade authorities, freeze and redemption controls, bridge signers, settlement dependencies. If those surfaces require disruptive remediation, the cost is legal, operational, and reputational, not merely technical. And EternaX Labs' report frames this as the cryptographic migration debt, the accumulated cost of replatforming tokenized infrastructure whose cryptographic assumptions become obsolete. The mechanism that makes it a liability rather than just a cost is this: the more successful your tokenized product becomes, the more expensive it is to replatform. Distribution partners, custody integrations, collateral framework approvals, cross chain dependencies, they all increase switching cost with every month of adoption. You do not reduce migration liability by succeeding it, you compound it. The question that every institution should be adding to every tokenization evaluation right now: does this rail create avoidable future migration liability for an asset that I intend to hold for 10 years? Google, Coinbase, and EternaX have made the question impossible to defer. So, success actually does not reduce your migration liability, it compounds it. The more your tokenized product succeeds, the more expensive it becomes to fix the rail underneath.
No, this is great, Mansi. I think thanks for referring the report that we at EternaX have been saying for a considerable time now, and it very well fits into your narrative of the expanding tokenization and the collateralization of those tokenized assets and the distribution angle, where we are seeing that the volumes would be going in trillions and not in billions but in trillions. It can be multiples of 4, 5, 6 trillion dollars in terms of volumes. And Broadridge is already doing somewhat 1.2 trillion of volume just in a year. And this is something which is great in terms of we need to understand the impact of these tokenizations of assets on the blockchains. So what we are saying here, Mansi, is that if you are tokenizing, and you yourself had mentioned in your report that there are a lot of people that are getting into the game, they still have not entered into, and they are starting new products and stuff. So I would suggest go PQ native day one with EternaX. We have the benefits, we have market speed, we have the auditable privacy, and everything comes at day one, so that they do not suffer any migration debt. So that is what we are offering at EternaX. And I'll quickly recap now, Mansi, what you have said in this entire podcast. And first of all, thanks, Mansi, for writing such an extensive report. This has been an eye-opener for most of the tokenization friends and communities that we interact with. We will share the link of your report in the description for our listeners and users for them to review. So I'll quickly recap what you have said in this particular podcast. So first thing is, Larry Fink said that the tokenization is where the internet was in 1996. And what he did not say, and what this episode has, is that in 1996, the people who won were not those who built the most compelling homepage. They were the ones who, owned the pipes, the routing, the infrastructure, in this case, EternaX, and the DNS layers underneath every homepage that ever existed. So the 5 conclusions that you have given, Mansi, is that this is what should be permanently, changed after this episode are: 1, $26 billion market is $15 billion market. Represented value is not equal to distributed value. Recorded assets are not circulating instruments. If your allocation framework starts with the headline, it starts wrong. Second, the money leg is already 10 times larger than the asset leg. JPMorgan Kinex's alone clears more tokenized daily than the entire RWA asset market and has circulated in its history. So the BIS is prototyping the unified ledger for $195 trillion in annual wholesale flow, and most institutional frameworks are building exposure to the smaller market. 3, infrastructure compounds, wrapper, compress. Transfer agents, custodians, FMI operators are all toll roads. Wrappers are the cars, they are the Teslas. Security at 1.25 billion pre-money is what a toll road looks like when the public markets price it. So no wrapper business commands a comparable multiple. Fourth, a wrapper and jurisdiction where your product architecture, blockchain selection becomes primary as well, which we will discuss in the next, in the next segment. So regulation S versus regulation D, Luxembourg versus Ireland versus Hong Kong versus ADGM. Those decisions determine whether your product has an $800 million distribution path or a $3 million ceiling. Last, and where your, Mansi, we disagreed with you, me and Dariia both, as the co-founders of EternaX, we disagreed. But the last part is the rail choice, that is the plumbing, that is the infrastructure, and that is basically the DNS layer beneath, and that is EternaX. So the rail choice is a future liability decision that compounds with every successful month. Google, Coinbase, and we at EternaX have moved the quantum timeline from theoretical to institutional. We have already, we are already launching our paper on the native novel PQ scheme that we have made. The paper will be out within next week, and we'll make sure that we hand it out to all the enterprise and the institutions and the benefits of the design. So success does not reduce your migration liability, it compounds it, and we want that you be successful with no risk compounding, and hence you have to sit day one with us on EternaX, become PQ native. That's all. So the question underneath all of this is, the question this episode was built to leave with you is, have you been underwriting a wrong layer? Mansi's full report, the tokenization mispricing, is linked in the show notes. If the episode forced you to rethink one assumption, send it to the person in your institution who most needs to hear it. See you next time. Thank you, Mansi. Thank you, Dariia, for all the time.
Thank you, Mansi, and see you all in the next episodes of the Control Loop.